Most people think a portfolio of two volatile investments must be just as volatile as the average of the two. Wrong. When you mix assets that move differently, the total swing can drop to half what you'd predict. That's not a trick, it's math. Diversification became a formal investment principle in the 1950s when economist Harry Markowitz proved something counterintuitive. Combining risky assets can produce a result less risky than any single ingredient. Before that, spreading money around was common sense. After Markowitz, it became a measurable, calculable advantage. Markets rewarded people who understood that independence between assets, measured by something called correlation, creates a cushion. The system now treats diversification as the only free lunch in finance, lower risk without sacrificing expected return, if you do it right. Let's define the core term. Correlation measures how two things move relative to each other, on a scale from -1 to +1. +1 means they move in lockstep, tech stocks all falling together when interest rates rise. 0 means no relationship. One goes up, the other does whatever. -1 means they move in opposite directions. Stocks rise while bonds fall. Think of correlation like synchronized swimming versus a mosh pit. High correlation is synchronized. Everyone moves together. Low correlation is the mosh pit. Collisions happen, but individuals zigzag independently. Diversification banks on the mosh pit. Here's how it works mechanically. Imagine asset. Swings up or down 15% in a typical year, and asset B swings 12%. If you put half your money in each, you'd expect the combined portfolio to swing somewhere around 13 or 14%, right? Just averaging the two. But if A and B move independently, say A tracks oil prices and B tracks interest rates, their swings won't align. Some years A drops 15% while B climbs 12%. Your total change is only down 1.5%. Other years both drop and you get the full hit. But over many periods, the mismatches smooth out the ride. The math shows that a 50-50 mix of those two assets, if they have zero correlation, produces a portfolio that swings closer to 8 or 9%, far less than either component. That gap between 14% and 9% is the diversification dividend. Now let's see example math clearly labeled. Asset A has returns that bounce between +15% and -15%. Asset B bounces between +12% and -12%. If they're perfectly synchronized, both up together, both down together, a 50-50 split gives you returns bouncing between +13.5% and -13.5%. No benefit, but if they're uncorrelated, the portfolio's standard deviation, the technical term for swing size, drops to around 9.5%. That's a 30% reduction in variability. If they're negatively correlated, one zigs when the other zags, the swing can shrink even further, down to 1 or 2% in the extreme case. The formula involves squaring weights and variances, then adding a correlation term that either inflates or deflates the total. The key insight: correlation acts like a volume knob. High correlation cranks up total risk back toward the average. Low correlation dials it down below what simple averaging predicts. The portfolio's overall volatility isn't just the average of its parts because volatility compounds in a non-linear way. When two assets move independently, their bad days don't always overlap. Asset A crashes on Monday, asset B holds flat. Asset B dips on Thursday, asset A recovers. Your account balance traces a smoother line than either asset alone. This is why a basket of 10 stocks, each volatile on its own, can produce steadier results than any single stock. The trick is ensuring the 10 don't all crash for the same reason. If they're all airlines, a fuel price spike hits them together. No diversification benefit. If they're an airline, a pharma company, a utility, a tech firm, and a gold miner, their risks scatter across the economy. One sector's disaster is another's opportunity. People misunderstand diversification in 3 big ways. First, they think it means own a lot of things. Owning 50 tech stocks is concentration, not diversification. They'll all fall when the Nasdaq drops. True diversification requires different risk drivers. Second, they assume diversification eliminates risk. It doesn't. It reduces specific risk, the chance that one company's scandal or one sector's slump wipes you out, but it can't remove market risk, the baseline volatility of the whole economy. If every asset class drops together in a financial crisis, diversification offers no escape. Third, people expect diversification to boost returns. It doesn't. It smooths the ride. A diversified portfolio will lag a hot sector during a boom. Your tech stocks soar, but your bonds and commodities drag. The payoff comes during the bust. when those laggards cushion the crash. Diversification has hard limits. Correlation isn't fixed, it can spike during crises. Assets that normally move independently suddenly move together when everyone panics and sells everything at once. This happened in 2008 and March 2020. Stocks, real estate, commodities, all plunged in unison. The diversification benefit evaporated exactly when investors needed it most. Another edge case, over-diversification, sometimes called diversification. If you own 200 funds that all hold the same mega-cap stocks, you've just bought the market index with extra fees. Beyond a certain point, research suggests 15 to 30 distinct positions. Additional holdings add complexity without meaningfully lowering risk. You also can't diversify away from your own behavior. If you panic sell the whole portfolio during a dip, the asset mix didn't matter. Diversification is the mathematical principle that combining assets with low correlation reduces total portfolio variability below the weighted average of individual asset volatilities. It exists because different parts of the economy respond differently to the same events. That independence creates natural offsets. It operates through the mechanics of correlation, turning independent movements into a smoother aggregate outcome. It's not a guarantee, not a return booster, and not a crisis shield. It's a structural advantage that makes the ride less jarring over time, as long as the assets remain genuinely different.